The most anticipated earnings releases for the week of December 18, 2023, presented by Earnings Whispers. It is the last week for earnings releases in 2023 with more than 30 companies scheduled to report, including 10 S&P 500 companies. We are still more than a month away from the next earnings season, but so far, unless you own energy stocks, you are most likely up since the companies you own reported earnings last. That's particularly true for real estate stocks, with the REITs all reporting strong earnings last quarter and all trading higher since their report. Monday we will get results from HEICO, which has broken above $180 and is now retesting. Most likely, as long as it holds this level after earnings, the bigger move going forward is higher. FedEx reports results after the close on Tuesday, which is currently at a new high for the stock. The company is facing headwinds from Amazon but still benefiting from the Yellow bankruptcy. We aren't going to hear anything from the transports for the next few weeks, so there might be a lot weighing on their results. Accenture is scheduled to report before the open on Tuesday, with expectations for muted top-line results, but margins helping the company beat on the bottom line. Will that be enough for the stock to advance? Well, sentiment hit a multi-year bearish level in March, and, while sentiment has improved, investors remain bearish. Furthermore, short interest hasn't moved lower much since the end of May, when it neared pandemic levels, and with the stock back at its highest since the start of 2022, essentially all the short sellers have losses on their positions. With that, it might not take much for the stock to continue higher. Micron Technology tops the list of companies reporting on Wednesday, and it too is at a high. The company already told us what to expect, so the focus will be on guidance, with expectations leaning favorably as pricing improves. And yes, BlackBerry is still around. It isn't new information, but the company has transitioned from a mobile device company to a security software and Internet of Things company. Perhaps more importantly, though, this time around, the story will revolve around the new CEO and the structure of the company, as it divides into two segments. Most eyes will be on Nike this week. Historically, the best time to buy shares of Nike is after it reports fiscal first quarter results, and that has certainly held true this time around. The question, as we approach second quarter results, is whether the company's inventory issues are behind it and now margins can offset revenue that still looks on the soft side. Despite the rally, investors aren't quite buying into the story, and sentiment is just now coming off its multi-year low. The market repeatedly doubts the strength in travel, and perhaps that is a shoe that is about to drop, but that's not the expectation going into Carnival's report on Thursday. In the near term, the stock looks stretched, but it is just now coming into the $19 level it reached after earnings in June, with recent data tracking favorably. That means the recent pullback represented a higher low, and unless we hear something different, earnings are trending higher, which gives the edge to a move above $19, so positive results and a gap lower on the news may present a buying opportunity. There isn't a half day of trading before Christmas this year, but there isn't anything on the earnings calendar for Friday either. Monday, of course, will be closed for Christmas Day, and the following Monday will be closed for New Year's Day, meaning the stretch of light volume trading will begin on Friday. Once again, there aren't enough companies reporting this week with option contracts to fill up our chart of implied moves. Surprisingly to us, CarMax has averaged an 11% reaction to earnings over the past several quarters, but only 9% this time around. That's particularly interesting as the stock fills the gap from last earnings and expectations are still weak. Of course, the market this week is reacting to lower interest rates in the future, so the reaction to CarMax's results will be based on whether recent weakness overrides future improvements.